What I'm about to reveal to you was one of the most important parts that helped me to become a consistently profitable trader and acquire multiple six figures in funding. If you don't get this part right, you will struggle to make money as a forex trader. So what exactly is this important part? It's your entry model, which is why in this video, I'm going to show you how to build a profitable entry model. I'm going to tell you the timeframes you should be using, how to identify your entry confirmations, and how you should be managing your trades so you can become profitable. How to build a profitable entry model. First of all, why do you need an entry model? An entry model makes it easier for you to identify when it's time to take a trade and how to manage your trades properly. But here's the most important part. Every profitable trader has one. Having an entry model makes the process of execution simpler and consistent, which will also help with reducing overtrading, removing hesitation, and improving your confidence while trading. That's just some of the reasons why you need a profitable entry model. You need a process, a consistent process that you can use, which is going to make your execution easier and your actual process while trading consistent, which as a result is going to produce consistent profitability in your trading. Quickly, before we go on, if you would like to work with me and get my help so you can become profitable, get funded, start making consistent payouts, do consider checking out the link in the description. So here are the three components of an entry model. From my own experience in the markets, there are three main components you need to build an entry model, a profitable entry model. Component number one, you need to know your time frame. Component number two, you need to know your entry confirmations, the set of rules that will validate taking a trade. And component number three, how you will manage your trades, trade management. And in this video, we're going to be going through all three of these components. Time frame. So the first component to building an entry model is to choose and select one time frame. This is a time frame that you'll be using to identify your entry confirmations, which we'll be going through in component 2, and actually enter your trades from. So this is the time frame, your entry time frame that you'll, like I said, use to validate an entry and also will basically enter your trades from. So what time frames should you use though? Okay, is there a right time frame for you to be using? Choosing your time frame. When choosing a time frame for your entry model, it's important to know that there is no right or wrong time frame. The time frame you use will be based on your own style of trading. So if you're a scalper, your time frame is going to be lower than if you're a swing trader. But my rule of thumb is this: choose the time frame you enjoy trading the most. Find the easiest to analyze and isn't overwhelming to trade. What time frame do I use? So the time frame I use for my own entry model is the 15-minute time frame. And the reason I use this time frame is because I'm a day trader. This time frame also suits my own personality. So it's not too fast paced for like the 5-minute or the 1-minute. It's not too quick. I don't like trading at too quick of a time frame. But the 15-minute is also not slow enough where I become disengaged with the markets or lose interest. So going off that information, you need to select the time frame that, like I've said, fits your personality. What time frame do you like to trade? And have it be a time frame that you're comfortable with trading, that, like I said here, isn't too quick for you or isn't too slow. That's going to be the right time frame. The right time frame is the entry time frame that you enjoy trading and that is right for you, which will be different for every trader. Confirmations. The second component to building an entry model is to identify your entry confirmations. These confirmations are a set of rules that you need to see happen on the charts on your entry time frame that you've chosen to validate and confirm taking a trade. How you identify and create these set of rules, your entry confirmations, will depend on what we're going to be talking about now. Identifying your entry criteria. So when creating this set of rules for your entry criteria, so your entry confirmations, I personally prefer to keep it simple and give myself no more than 3 rules to follow. The simpler the better. You don't want to overcomplicate your process. It's just going to make it harder to actually stick to and execute on consistently. So I personally recommend having no more than 3 rules. So how you will identify these rules is by backtesting and watching the charts for common price movements that repeat themselves over and over again. This is how you build an edge. So you're looking for rules, you're looking for price movements, common patterns and movements in price that repeat themselves. And then what you're going to be doing is identifying rules that indicate to you that these price movements are about to happen again. And this is what we'll be speaking on now. So creating your rules. Once you've identified a common pattern, price movement on your entry time frame, write down 3 technical rules that indicate to you that price is likely to repeat these moves again. So like I just said, while you are backtesting or watching the charts and you see a common pattern in price, you see that when these technical rules happen, it's very likely that price is going to move in a certain direction. And so what you're then going to do is write down these rules, preferably no more than 3, that indicate to you that price is about to make these movements again. And so this is how you build your entry model. This is how you build and identify your entry confirmations. As an example, here's what my own rules look like. My entry confirmations. To help you understand better, this is a screenshot from my own entry rules, which I've identified by backtesting and studying the 15-minute time frame for price movements that repeat themselves. So when price breaks structure with momentum and candle closes above or below the structure on my entry time frame, this indicates to me that price is likely to move in a certain direction. And so you can see on your screen here, this is my 3 rules that validate an entry. And I've identified these rules by studying the charts, backtesting, and watching for common price movements. Once I've seen and identified these common patterns, these common movements in price that repeat themselves, I've created or identified 3 rules that is going to help me to identify when this price movement is likely to happen again. And this is how we're building our entry confirmations and how you need to be building your entry confirmations as well. Writing your entry statement. So once you know your entry confirmations, get them written down. It's so important that you have your process written down. So here's what it will look like. When I see X, Y, and Z, your 3 rules, the set of rules that indicate price is likely to move in a certain way again, happen on your entry time frame, this confirms a valid entry. This is very simple, just writing it down, writing your entry statement down. But again, I've spoken about this before, the amount of traders I have worked with who haven't got their process written down, it amazes me. You need to have your process, your entry confirmations clearly written down so that it makes it easier for you to follow them and execute on them consistently. Trade management. So trade management is the last component for building a profitable entry model. If you get this part wrong, you will struggle to trade profitably and you won't make money. So how should you manage your trades properly? How to manage your trades. When developing your trade management plan as part of your entry model, you need to know your take profit targets. So this is where you exit every single one of your trades. Your stop loss placement. So where you want to actually get out of the trade for a loss, you need to know where your stop losses are going to be placed, whether that's based on technicals or discretionary trading. Either way, it needs to be written down and put down and a part of your trade management plan. You also need to know how much you will risk per trade. And so it's best to use, from my own experience, a fixed percentage of your account. And lastly here, you need to know if you'll move your stops to break even. And so when you will take the risk off the trades. Pause the video, get these written down or take a screenshot and make sure that these components are built in to your entry model as part of component number 3, your trade management. Knowing what's right for you. How you manage your trades, based on the guide from the previous page we just went through, will depend on your own risk tolerance and style of trading. And these will be identified by backtesting and collecting data on your specific strategy and how price actually plays out while you are in a trade. So that's how you're going to answer the questions that or the statements we went through on the previous page on how you need to be managing your trades. You need to be studying, backtesting your system and identifying how it plays out. So here's what my trade management plan looks like to give you a better idea of how you should be managing your trades. How I manage my trades. So I move my stop loss to break even when price reaches 2R in profit. Because I know that if price reaches 2R in profit, so I'm in a trade, it reaches 2R, and if it doesn't continue in my favor, whether I'm long or short, if that trade doesn't continue in my favor after reaching 2R in profit, I know that from my data, it's very likely that the trade will then reverse on me. So I'll then move my stop loss to break even once price reaches 2R in profit, because I understand how my system plays out. And so you can begin to understand here how you need to be identifying how you manage your trades. Study how price plays out once you get your entry confirmations and see how far price moves. It might just be 1R in profit and then you need to move to break even. Or you might not move to break even because that's not what the system requires you to do. Or the data you have on how price moves out. It's not good for you to move to break even. So these are all things you need to identify. And if you would like my help with all of this, building your strategy, becoming profitable, do check out the link in the description. So I also use a fixed 1-to-3 risk to reward ratio. This is based on, again, collecting data on my system and based on how far price is likely to move when my edge is actually presented. So when I'm in a trade, I understand that a good 80%, 90% of my winning trades, they will push to 1-to-3R. Okay, and I understand that from collecting data on my edge. You need to identify the same to build your trade management plan and to answer those questions based on what we previously went through. So I only move my stop loss to break even once price reaches 2R in profit, and all my trades will exit at 1-to-3 risk to reward ratio. Again, that's based on my own trading style and how price plays out. To finish up here is an action step for you to take. So first of all, select your entry time frame of choice. Then by backtesting, identify the set of rules, the confirmations that indicate to you that price is likely to move in a certain way. This is your entry confirmation rules. And lastly, create your trade management plan. Like I said before, it's so important that your entire entry model and process is clearly written down. I hope this video has helped, and I will see you in the next one.